Right, so let's take a look at the required. So this required says you are required to critically review the taxable income calculation performed by the financial manager. You're required to comment on any mistakes that the financial manager may have made and indicate why it is a mistake. No marks will be awarded for calculations. That's important here. And the management of Stripes Limited has indicated that they wish to pay the lowest tax liability possible and will elect any legal and ethical option to reduce or defer the liability. Now that's also quite important because it means that there are some areas in the question where they can claim a bigger allowance or a quicker allowance or an accelerated allowance, they will do so. So for example, if we go back to those pallets, you'll remember that we had some pallets. If I can just find them here quickly. Yes, number 7. Those pallets, the financial manager claimed a wear and tear allowance. You'll recall, if I just take you back up to the calculation, over 3 years. But we also saw that in terms of interpretation note 47, they could have claimed a bigger amount. So that is, for example, something that you would have to comment on. Now, I'm not going to just go and talk about all of the items in this calculation have been wrong, because we've already discussed that mostly during the reading time. So what I'm going to do is I'm going to do the tax calculation with you guys as it should have been done. Now again, please make sure that you understand what I'm saying there. That is not what was required here. You're required to say what was wrong and then why is it wrong. And you'll find that in the solution. So please work for the solution in detail for that. I'm not going to just write out everything. You'll see here it is quite detailed, everything. So what I'm going to do is I'm going to do the calculation here just to show you guys again what it should have been. If there are some areas where you're a little bit uncertain, then you can see what it should have looked like. So if you are happy with the solution, everything that you've done, then you can stop the video at this point in time and end this tutorial. You don't have to watch this video or any videos that might come after this in respect of this mock test. Okay, so let's go and do this. So just as usual, I'm just putting down my headings, and this is just a reminder for you as well to always put down your headings when you have to do a calculation question. Okay, so we're going to go through it line by line and then do it. So note 1 is the sales. So we had local sales and we had international or export sales. So local sales 41850 600 is the invoiced amount. There's 15% VAT on that. So 41850 600 times 100 over 150. $36,391,826. And the foreign customers, this is 0 rated, just reminding you. So the amount that is given there is correct for us. Then number 2. So number 2, we have opening inventory. Section 22.2. And the opening inventories, they told us was correct, so that's at 8.9 million there. That would be claimed as a deduction. 8.9 million. We have our manufacturing costs under section 11A. These manufacturing costs are 27.5. And then we have our closing inventory or closing stock. Closing inventory, section 22.1, and the rule says we use the lower of cost or market value. So what do we have here? We've got fridges, washing machines, stoves, and other. Fridges, washing machine, stoves, and other. So for each of these, we need to use the lower of the cost or the market value. So fridges is 2128. $2,688 for the washing. The stoves, we have to use also the cost. This NRV is lower, but remember the NRV has a deduction for cost to sell, which we didn't take into account, and that is for the market value is 4,350. So and then other 2,464. Right, and that amount would be added back. So again, what I would now do, for those of you guys who are following around, just go and compare that to what we have done over there. Right, number 3 is the restraint of trade, and we received this restraint of trade in the past year. This told you 3 years ago that we received it, and restraint of trade would not have been taxable at that point in time because the restraint of trade is capital in nature. So you just restraint, and then I'm just going to say elections section 11CA not available to the company. Okay, then section number 4 is this provision here. And there's no deduction for provisions. Section 23E tells us that. All right. Then number 5, this is where we get the dividend, 800,000 times 8%. So was it 8% now? Yes. So 64,000. That amount is exempt in terms of section 10(1)(k). And then we have these expenses incurred, and there's no deduction as not in the production of income. And remember, guys, when we have questions, you can either give the reference or you can basically explain yourself like I've done there. This would be the reference to the Act if you wanted to put that down. Number 6 is the foreign dividend. It was 50,000. After tax of 5,000 has been withheld. So let's just get that right. So the foreign dividend is 50,000 plus 5,000, 55,000. Our section 10(b)(3) exemption is then 55,000. Times 8/28. And then there were some expenses incurred, 120 rands, and there's no deduction allowed on foreign dividend expenses. Section 23Q tells us that. Right, then number 7 is the wooden pallets that were purchased in this tax year. So the cost per pallet is 57,500 times 100 over 115 divided by 25 equals 2,000. So thus, cost less than 7,000. So thus, claim in full. So you can claim 2,000. You have to write it down to R1, and there's 25 of those items. 49975, and this is section 11E deduction. And remember guys, this is not told to us in section 11E. This is told to us in interpretation note 47. So that's something that SARS allows. Then number 8. So this is now where we have this Honda passenger vehicle. It was purchased on the 1st of November. So we had it for 11 months. They are written off over 5 years. So let's actually start with that. So it's 368,000 over 5 years, and we had it for 11 months. All right. The general manager is responsible for all the costs. Stripes paid an insurance premium of 2,875 and 26,000 on fuel. Okay, so let's get the fuel out of the way. It's easier. Section 11A. So that's 26,000. Then we have the insurance. There's the total. 2,875 less input tax, which is 2,875 times 15 over 115 times 90%. Okay, so I'm just rounding it up. So it gives us 2,537. That 2,537 is a monthly amount. So that's 2,537 times 11 months. 2,7,907. And then we have the output tax on the fringe benefit, section 11A. So the output tax on the fringe benefit is calculated as the cost of the vehicle. I think it was 368. Yes, 368 times 100 over 115, always excluding the VAT. I know you couldn't claim it, but remember it always works like that. Times 0.3% because you couldn't claim the VAT. Minus 85 rands because he's responsible for all the maintenance cost. Times 15 over 115 times 11 months times 90%. And that gives me 1130. Just check myself one more time. Wait. Yes. All right. Then we have the block of flats that was purchased. So we get a section 13.6 allowance. This is now number 9. And it is on the cost including VAT, because we wouldn't have been able to claim the VAT because it was used for residential accommodation only. And then the rest of this is a discussion about those rentals. So the rental income in this case should be from October to September. 20 flats, I think, yes. 20 units times 8,000 rands times this 8,000 rands, yes, times 12 months. Sorry, the one thing I haven't really discussed here previously is the low cost residential units check. Remember, you have to always check for that. Now, the low cost residential units, if you say 9120 divided by 20 units, that's a cost, including VAT divided by 20, you get 456. That's the cost per unit. Now, because that already exceeds our threshold of 350,000, it is therefore not allowed. It's not a low cost residential unit. Okay, then we have our admin building. So admin buildings. So here's the 2005 one, and this is not allowed as it's before 1 April 2007. And then the new one that was built, where is that? It's 4 million. VAT. We could only claim 90% of the VAT. So this gives us our cost. So we could, so 60% of, or sorry, 10% of the 600,000, 60,000 is therefore forms part of the cost. Okay, everything else there, fine. Salaries and wages, and then there was trading stock given away. $15,000. Sorry, 15 million, I think. That's the, yes, salaries and wages. And then we have the stock given as a fringe benefit. Section 22.8 says recoup market value. Okay, then the output tax on the fringe benefit. This is the same principle as for the company car. What would be the output tax on the fringe benefit? Now, the cash equivalent, this is what you use for the 7th schedule, is the lower of cost or market value. Now, I don't want you to get too worried about this for now, if you haven't yet studied fringe benefits. So you always apply the VAT fraction to that. Again, guys, not something I want you to be too worried about for now. This is also something that is actually not always even shown in solutions. Okay, really don't worry about that one. Then number 12, the patent, purchase of 500,000. It was written down by 85,000, but we don't recognize that. So the patent, section 11 GC, $500,000 times 5%, 25,000. I'm just going to make a comment here. Impairment, no deduction for tax. All right, so number 13. On the 1st of July 2019, they purchased a second-hand manufacturing machine from Mr. Lewis, who was not a VAT vendor, for $850, brought into use in the manufacturing process. Then a fire broke out, and stock and the machine was destroyed, and they received $1,040,000 from the insurance company. Okay, so let's do number 13. So the first thing with number 13 is the stock destroyed. Again, remember, the cost was already included in the opening stock, so it was claimed as a deduction. So we only worry about that $320. That's an amount including VAT. The stock is 100% relating to the taxable business, so we don't apportion the VAT or anything like that. It gets included in our gross income. 278, 261. Right, then this machine that was destroyed. So let's start with the cost. The cost of this machine was $850,000. Second-hand machine, so we have to multiply it by 100 over 150 to get the notional input VAT out. Again, the machine is only used in the taxable business, so we claim 100% of the notional input tax. So that's 739,130. From that, we deduct our section 12C. Now, when was it purchased? The 1st of July 2019, so it's a 2019 year. And this is a second-hand machine, so in each year, we can only claim 20% under section 12C. So 147,826, 147,826, 147,826, 147,826. And important, remember that you have to show it and claim it in the current year as well. So 147,826. It's going to make this note here. The sum here is 591,304. This gives me 147,826 as the tax value when it was destroyed. So then we have our insurance proceeds that we received. So this is usually our selling price. So we say insurance proceeds limited to original cost. And remember what that means. It doesn't mean you have to use the original cost. It just means it can't exceed the original cost. Now this is already, you can see, 720,000, including the VAT amount. So that's not an issue. So 720 times 100 over 115 gives us 626,087. So that gives us a recoupment 626,087 minus the tax value of 478,261. That gets included in our taxable income. We have to do a capital gain calculation, and just on a note, this is also something that they didn't do, the financial manager. The proceeds is the 626,087, that amount, minus the recoupment 478,261. 147826. The base cost is the cost of the asset, which is at 739,130. 739,130 less the allowances. The allowances is that 591,304, the total there. And that gives us 147826. So there is no capital gain. We also know that don't expect it to be a capital gain because the amount that we receive upon the disposal, 626,087, does not exceed the original cost. Right, then we have number 14, which is this machine that we imported. Okay, so remember now, we imported the machine, so there must be forex gains and losses as well. Let's start with the cost of the machine. That's what I always recommend. It's the easiest part and it helps us. So, machine imported. So what is the cost? The cost is the actual cost of this machine translated. So it's 180,000 translated on the transaction date of 1435. $2,583. Then it is the import duties of 150. And that's it. 2733. So this is a new machine under section 12C. We claim 2733. This is the first year we brought into use, so we claim 40%. So 1093200. Then we have our forex gains, losses. So 2021, make sure you see that. Section 24I7 applies. Why? Because we incurred forex gains and losses last year, but we're only bringing into account or starting to use the asset this year. Section 24I7. Always be on the lookout for that. Alright, so let's see if we had a gain or a loss. So we do it from transaction date to translation date. So on transaction date, we believed that we would have 1435 as what we would spend. But now we see we're only going to spend 1349. So, does it make you feel good or bad? Pretty good. That's a forex gain. So it is the dollar amount, 180,000 times 1435 minus 1349. So I always just do it with the latest one first. I know if you know, just look at the calculation there, it looks like it's a negative amount. But please remember, you have to use your logic. That's 154,800. Right, forex gain. Then 2022, so this is just your normal section 24I that we refer to here. We now go from translation date to realization date. On translation date, we thought we were going to pay 1349, but we now end up paying 1511. So does it make you feel good or bad? Pretty bad. So forex loss. So 1511 minus 13.49. $291,600 loss. Okay, then number 15. This is this warehouse information. The current year amount we can claim. Current year, section 11A, 293,000. capital 3. And then prepaid. Section 23H is what we talk about here. So prepaid not exceeding 6 months. Do we have any of those? We do. It's this warehouse rental. So we can claim that. 120,000. So prepayments exceeding 6 months is the, what do we have here? Security and insurance. Security and insurance. The security and insurance, 80,000 plus 18,667. 80,000 plus 18,667 gives us 98,667. As this does not exceed 100,000, can claim. And there we go, 98667. Okay, and then number 16 is the sale of the vacant piece of land. Land sold, we've got proceeds, we've got the base cost, there's no recoupment because there's no allowances, 1.5 minus 800,000. Is a 700,000 capital gain. That capital gain goes into our CDT column. That's it. Then number 17 is the assessed capital loss of 130,000. So all we have to do now is add up all of our capital gains, 700,000. That's our aggregate capital gain. We have our capital loss brought forward, the 130,000. This gives us our net capital gain, 570,000. They have our inclusion rate of 80%. So 456,000 is our taxable capital gain. That amount goes into my rands column. And now we add up everything. And that is our taxable income. And that's it. So you can compare this to what was done. When you're answering this type of question, this is what I would do in my head in any cases. Think about the calculations I would be performing. So again, guys, you would not have received your marks for doing these calculations. This is all about the discussion. But like I said, we've already discussed that, and it is quite, you'll see if you look at the solution, it's all discussed therein. Alright, so that's it. I hope it went well. Again, guys, if you picked up any mistakes here, please make sure to go back to the work and revise it. Very well done.